I'm Jonathan Carter, founder and principal accountant at Cata Accounting Solutions. I was a member of the inaugural Intuit Accountants Council, a former Intuit All-Star. We received the 2018 Inspire Accountant Award. We're Elite Pro Advisors, QBO Advanced Certified, and we're on the Insightful Accountant Top 100 Pro Advisor list for 2021, 2, and 3. And this past September, we're very honored to receive the award for CPB Firm of the Year. That was the biggest feather in the cap that we've had so far. We are a trusted advisor for several bookkeeping firms. We love collaborating with bookkeepers. I am considered a thought leader in technology and accounting, but I have stepped back a bit from being a super early adopter of technology. Now we more focus on items once we have buy-in and some kind of recommendations from industry colleagues. We also love working with technology companies, particularly content creators and digital marketers and the like. So today we're talking about that year-end item. So the one thing that I'm going to talk a bit about is the type of engagement and where some annoyances can happen. And then a lot of this presentation, you may have seen portions of it or all of it in the past. Now I have been through and updated it where I thought it was appropriate. So we're going to go through the type of engagements, general information, major events and what those might be, the balance sheet, income statement, and we'll hopefully have some room for questions. If you do have questions live as we're going, please, by all means, raise your hand, ask your questions. Sandra, if you wouldn't mind, just popping in and repeating those if it's not from somebody who's allowed themselves to be promoted to a panelist.
Sure, no problem.
All right. So first poll question. Which type of engagement requires the accountant to review all the transactions to ensure they are correct? Is it A, a review, B, an audit, C, compiled financial statements, D, a tax return, or E, none of the above? And right now, hosts and panelists cannot vote. So we're going to have to just relaunch this poll. So just give it one moment, please. I'm just curious, can you see the poll on my screen or no? Yeah? Okay, so I better move it off before I answer, right? Mm-hmm.
Okay, so it's not letting me change it. Tanya said that if we have issues with it, you guys could just answer in the chat too.
Okay.
Lynn?
It's not working here either.
Okay.
Yeah, it's not letting me. I thought there was like on the three little tabs. I thought unless somebody else knows how I can do that.
Carrie, yes, this is being recorded. And it'll be launched on, I think it's the YouTube channel in a few days.
I think so, yeah. Yeah, and Tanya usually sends in a recording of it as well. So that will go out within a couple of days as well. Okay.
All right. How is the poll questions answering going? I see nothing in the chat.
So Lynn has answered, and then it looks like there's 7 out of 7 have answered.
Okay, so excellent.
We got a few people in the chat answering. Okay, so I will end the poll.
Yeah, I think that's about everybody. Except for me.
And I will share. I'll share these results, but most people answered in the chat.
Okay. So the correct answer is none of the above. In a review or audit engagement, the accountants are testing samples. They're not looking at every single transaction. So in no instance are we going to see if your client put through dog food. It would probably be considered materially insignificant and be skipped in the testing process. I'm not going to talk a lot about the audit or review process. I'm not licensed to do audit or review, so I don't feel I should be teaching about it. However, I do understand the process quite well. And in none of these types of engagements will the accountant dig in and look at every single transaction. So that's a common misconception. And Carrie, did you want to ask something? I thought I saw your hand up there. No? Okay, you're okay. So one way we can add value is by knowing what type of engagement is required by the client. So quite often oh, sorry, Lynn, go ahead.
Yeah, Jonathan, so if none of the above apply, when does the accountant look at everything?
At every single transaction? They
Yeah.
won't.
Never.
They
Good
won't.
to know.
It
Thank
is, I mean, there might be something like, it's a criminal case or there's a lawsuit and there's a much deeper dive in forensic accounting done. Even then, the accountant is probably not looking at every transaction. Yeah, Steve.
Go on. Just one thing that I think we have to get into, though, is that when we look at the financial statements, we do dive down into them if we see anything odd, right? So that's really where it is, or at least that's the one I think that gives a little bit of misconception. There we go through and dig down and get till we hit something solid.
Well, like for instance, if like there's a negative AR balance, negative inventory balance, we might start digging into those kind of things.
Weird and wacky is what
yes, weird and wacky. That's a good way of putting it. I had a client years ago, her bookkeeper missed a decimal place. So she had like, on, I think it was like something like $150,000 of revenue. She had like $300,000 in accounts payable. I was just like, I don't think that's right. So, but even then, we're often going to come back, especially as an accountant who only prepares compiled financial statements. We're often going to come back and ask that question. And I think that is probably one of the biggest frustrations for bookkeepers is, especially with somebody like Kata, where we know QuickBooks and we know we can go in and we can find that on the transaction. We have to be careful about crossing that line from a compiled financial statements engagement or compilation engagement into an audit or review. We're not covered for it from insurance purposes. We're not licensed for it. And it is, in fact, something I have been slapped on the wrist for way back at the beginning of when I started my firm. Because that's what I want to do. As much as I could in QBO, and the answer is like, you should not be doing that. So
okay, so the only other time is when I send them my notes and say, not sure about this, or please take a serious look at this one because the client insisted or something like that.
Yeah, that's a good idea. Bring to the accountant's attention something specific either you have questions or discomfort about. And you have to use professional judgment as CPBs. And if the client is insisting on something, I mean, you have your professional standards. You might have to push back. And I know that can be really uncomfortable. And we've talked about that before. If you've
been there, done that, and I still pushed back and did it my way. Flagged a note for the accountant and said, yep, client wanted this. This is where I put it. You deal. It's not on me.
Yeah, that's fair. That's fair.
Okay.
So just to quickly go through some of these types of engagements, there could be an assurance engagement, audited or reviewed financials. Audited is the highest level. These must be performed by a licensed public accountant, and you can check the CPA registry to make sure that's safe. We've seen more and more disciplinary action taken against CPAs who are providing audit opinions and are not licensed in public accounting. And of course, if that happens to your client, that could create a whole other whack of problems, especially if they're fundraising or something like that, looking for investment, borrowing money, things like that. And then we can get either both audited and reviewed will provide audited financial statements or reviewed financial statements, an accountant's letter explaining their opinion and the level of assurance work that they did. And usually it's accompanied by a report to management, usually discussing, areas they think they could improve and things that they thought were good and things like that. So we go as high at CATA as compiled financial statements or a compilation engagement. This is similar to the old notice to reader statements. Those do not exist after December 14th, 2021. If the CPA is providing you those, then they are not up to date on the regulations from CPA. There is absolutely no assurance in a compilation engagement, and it will say as much on the accountant's letter. And the one thing that we are doing that is deeper is we need to know who the audience of those statements are and if they'll have access to further information should they need it. And then getting a better understanding of the basis of accounting and including that in a note to the financial statements, and getting like 18 sign-offs from management that they are responsible for the underlying data. It's actually it's 3, but it seems like a little bit of overkill, but that was one of the biggest things, is getting that sign-off that management understands they are responsible for the numbers. So you know what, actually I want to go back here a little bit. One thing to keep an eye on, and this is where value can be added early in the process, is if your client is going for lending or investment, any kind of agreement that might create a situation for an accelerated reporting timeline, or the requirements for a specific type of engagement. So one thing we're seeing frequently is clients not fully reading or understanding their lending agreements from BDC. Now, most of our clientele, they're finding that they require compiled financial statements within 90 days of the year end, within 3 months of the fiscal year end. And we did have an instance with a shared client with another firm that, you know, the client wanted us to just do the tax return. But through that tax return process, we found that one of the things they needed was a review engagement. So they weren't even aware that they needed it. And of course, they needed that review engagement completed, I think it was 4 months, within 4 months of the fiscal year end. And of course, you know, that can create problems, because now, you know, you're operating under the assumption it's a 6-month tax filing deadline, and now you have to like speed everything up, find somebody to review it, and then move forward. Another instance, if I'm just curious, does anybody have daycares? Okay, so I'll just be very brief about it, but regional reporting requirements. Oh, I saw Jennifer pop in and raise her hand. Regional reporting requirements can require audited financials, and it very much depends on the region, the province, and things like that. Because it flows through so many government bodies, that it really varies from place to place. What we've been finding is they're requiring audited financials within 4 months of the fiscal year end, which is quite an accelerated timeline for some of these daycares. So once you understand the type of engagement, then you can find the right accountant for your client to work with and go from there. So this is a definition from CPA Ontario, and I want to talk about financial information versus statements for a moment. So the financial information is all the underlying records, the receipts, the schedules, everything that you do as part of your process, bookkeeping process, and then more. It could include things like lease agreements, lending agreements, things like that. Reviewing those ahead of time and helping your client understand what they're getting into can be really helpful. And of course, you know, whatever accounting system is going to spit out financial reports, but those are not financial statements yet. Financial statements are prepared by an accountant. They're audited, reviewed, or compiled financial statements. This is according to the definitions from CPA. All right, so just quickly, everybody knows what an audit is. It's the highest typical level of assurance. We talked about the letters. You want an unqualified opinion. However, it is quite common for nonprofits to get a qualified opinion because they can't track where specific donations are coming from quite often. This can be a lot more serious if they're involved in political situations, because you have to be able to show that your money is not coming from foreign sources. Yeah, auditor's gonna test a large sample of transactions and review the risky material. And then the big difference is in the review, it's just going to be very similar, but not as in depth. Again, they'll give the opinion, they'll give the management letter, and so on. They're going to test, but they're not going to test as much. They are going to review the risky and material transactions, and you know, that's the right thing. So compiled financial statements, I mentioned, for year ends after December 14, 2021, there are no more notice to readers. And I still see notice to readers going out all the time. I still see financial institutions requesting notice to readers and things like that. But it's something good to be aware of, because it'll help you understand if the account you're working with is staying up to date on the regulations. So we talked mostly about this. Big things are basis of accounting, management's sole responsibility for the underlying financial information, and we need to know who these statements are for. Pressing the wrong button. So some basic general information. Who owns the company? Who are the shareholders? What's on the securities ledger? Things like that. Who are the directors? Who's signing the return? Who are the officers? Are there related and associated corporations that need to be identified and reported? And then, of course, there are some key identifiers for the company, such as the BN, the provincial corporation number, and the legal and operating names. Probably the funniest answer I got for business number was the phone number. So that sometimes people need a little bit of coaching to understand what these things are. Major events. Have there been changes in ownership? And this could happen through a restructure. So we just got informed this morning that one of our clients is doing a restructure effective November 30th. So we got a day's notice. It's not going to be the end of the world because the books are kept up to date on a monthly basis. And we've made them aware you're going to have to file 2 tax returns this year. And we're going to have to do it kind of quickly. And we're also going to have to speak to your investors and your lenders who require the compiled financial statements to understand the timelines and what they want to see. Now, imagine this is very friendly. I imagine everybody's just going to want to see the annual, which is typical. Even if the corporation is acquired, changes control mid-year, typically you're reporting the annual financial statements. So that's something to keep in mind. If there's a change of control and you know it's coming, really, really, really push your client to do it at a month end, or let them know it's going to cost a lot to reconcile the mid period. Like if they do it on like a May 15th, you're going to have to reconcile between the April 30th and May 15th in order to do that kind of weird tax return. Steve, you have a question?
Yeah. So this is only required in cases of change of ownership. Is that right?
It's change of control.
Change of control. Okay, sorry, missed that.
Yeah.
Nope.
So like if somebody is
right.
buying 10% of the company, that doesn't trigger the need for a T2. In the case we have, the company is approaching that 50 shareholder limit, and they're going to restructure to have the corporation owned by a limited partnership, and that limited partnership is going to be the former shareholders of the company.
And
So,
just to clarify, so the two, so you're going to do your annual, your standard tax return, your T2, and then they're going to do a stub financial statement for the period of whenever they took control back to the beginning of the fiscal. Is that right?
It depends on the requirements from the agreement.
Gotcha.
So what I think, and I don't have confirmation because literally I found out this morning, but what I think is going to happen, we're going to do a T2. Yeah. We'll do a T2 for November 30th. And then we'll do another T2 from December 1 to December 31st. And then we'll do financial statements for the calendar year because that's their operating year.
Thank you very much.
That is my assumption, but I don't have 100% clarity. We did work with a daycare who had a similar situation. They purchased the business 5 months into the year, and we had to do the financial statements for the entire year. The prior accountant did the first 5-month tax return, and then we had to do a 7-month tax return and reconcile the two with the financial statements, which was challenging, but it was a good challenge. Lynn.
So just to be clear, the change of ownership is not changing the fiscal year. You just have additional reporting.
Correct.
Okay, thank you.
Yeah. Now, fiscal years can be changed, but they have to be approved. We haven't had a lot of problem with that. It usually requires a stub period. And the only instances we've really done that is when somebody has a weird period, like my year end is January 3rd or, March 14th or something like that. So CRA's never given us pushback. Go ahead, Karen.
I was just going to say, I did that with a client I was doing books for. They did a restructure the end of June. This was a few years ago, but yeah, so did a year end for the end of June, and then they sold the company and the new people took over in November, did another year end, which then I thought it was good till March. And then the new company said, nah, we want a year end December. So I did another year end in December.
Oh my gosh.
It was like, oh, yeah.
Yeah.
Trying to do that in QBO and changing, or actually that was QuickBooks Desktop, but changing the fiscal year ends in the software it's a bit of a challenge.
Yeah. From an accountant standpoint, I mean, you need to know the underlying theory and be able to do it from, if you got to do a 15-day financial year, like you have to do it, right? You got to figure out how to make that work. All right. The one thing I'm going to highlight here, and I beat this to death, is the corporate record book. Updating it annually is a legal requirement. This is not oh, you ought to do this. This is like potential $25,000 fine per occurrence, potential 6 months in jail per occurrence. I've never heard of anybody getting those kind of penalties, but then again, I haven't dug into it too much. And I do know that if you get an audit from CRA, or if you're doing audited or reviewed financial statements, one of the first things that's going to be asked for is the corporate record book. So in there, you have to show the things like changes of directors and officers, accountants and lawyers, any sale of assets or shares or issuance of new shares, and then any amendments, issuance of dividends, or other major events. So that was a lot. Now we're going to get into the real meaty stuff where I think it really, really has more impact. And that is, what do the accountants do when we're working on the file? So we spend most of our time on the balance sheet. We want to know that all key accounts are being reconciled. It is possible to reconcile them all. We don't look at that because of the level of engagement that we do, but we're looking to see the bank accounts, the credit cards are reconciled, the CRA accounts are reconciled. Making sure that the AP and AR make sense, make sure that we have the key schedules and registers, and if we don't, we usually try to prepare them with the assistance of the bookkeeper and the client. And then making sure that stuff, we'd like to know, we won't necessarily check, but we need to know if assets and liabilities are supported by appropriate documentation. We're going to ask for the big meaty things. Like if the car was bought, we're going to want to see that. We're going to want to make sure it's not in a personal name, that it is in the company's. If there's a loan, we are going to want to see the loan agreement and amortization schedule to make sure interest is booked appropriately, things like that. And then every year for fixed assets, there should be a review to make sure that they are still functioning and real, and they haven't walked off the premises. So for reconciliations, again, we want to see the reconciliation report and the third-party statement. I want the statement balance on the third-party statement to match the statement balance on the reconciliation report, and the register balance on the reconciliation report to match the balance in the balance sheet. We have found instances where that doesn't happen. It's quite common in QBO when you do clean up after you've done the reconciliation that you'll have to just undo and redo that reconciliation. Typically, if it was a good reconciliation, it really doesn't take very long to do and redo. And it can save you hours of digging and trying to figure stuff out. Of course, we want nothing hanging. We want no hanging transactions. So hanging transactions are those that are old. They're usually either errors or uncashed checks by vendors if dinosaurs are still writing checks. Sorry, that was a little snide there. So checks that are more than 6 months old should be stale dated. Those items should go back in the AP and a new check should be issued. Often technology or just mistakes happen and expenses get booked twice, or maybe a bill payment gets booked as well as an expense getting booked. These things are going to fall out of the reconciliation. That's really going to be your first step to quality control. Accounts receivable, again, are you matching properly? When you get a payment, is that payment being matched to an accounts receivable, or is it being booked directly as a sale? If it's being booked directly as a sale and not matched to the receivable, you're probably double counting sales and creating a gigantic tax liability for the client. So be careful about that. We have seen that from bookkeepers in the past, but they tend not to be bookkeepers who would be in attendance today and continually learning and improving. So try to get the remittance advice from the client to make sure that the matching is correct. It'll just save cleanup after the fact, particularly if you're working with a larger organization, say like a university, a municipality, or a large customer, that they might be paying some invoices but not others at different points. It's best not to just match any payment to whatever's oldest, because then you'll not know what's missing and you'll have a hard time coordinating with their accounts payable department. Watch for bad debt. Those are the old items. Make sure that collection or some kind of evidence is there as to why it's being recognized as bad debt. One thing that is a common area of fraud is the owner making a sale, receiving the payment, putting the cash in their pocket, and then telling the bookkeeper that it's bad debt and they can't collect it. Now, if you have bad debt from a customer, you shouldn't be selling to that customer anymore. So this, similarly, this could happen in a sales situation where a salesperson goes to, visit a client, and the client's like, oh, here, I'll pay you out of petty cash. Then they pocket it and then say they couldn't collect it, and it's not going to be collected. Prepaid expenses, we'd love to see a schedule. We'd love to see, here's the balance, here are all the items that make up the balance, here's the reasons they're in there. That's what we'd really like to see. We don't see that very often. And it's a good quick value add, and it doesn't take a lot of time. Common items, rent, insurance, software licenses, retainers, things like that. I feel like I'm flying today, so if you have questions, please interject. All right, so inventory items. So just a little thing, the item details in QBO, it won't allow you to lock the file if you have negative items, which can happen if you're tracking inventory in QBO. So make sure you check on that. Of course, any stolen, spoiled, or otherwise, useless inventory should be written off. And you need to ask, does the balance make sense? Like if the balance is identical to what it was in the last fiscal year end, that doesn't make sense. If the balance is negative, that doesn't make sense. Make your clients do inventory counts. We have seen clients coming back to us, here's the report from my system. And we ask, have you validated this? Have you checked? And they're like, no, we just ran the report. And this is one area where problems can accumulate over time. Really need to do that physical count. Again, inventory is a common area of theft and fraud. So it's something to keep an eye on for your clients. Fixed assets, I'd love to see a register. We almost never do. That register should show what the item is, how much it costs, the serial number, who's responsible for it, if it's in good working order, things like that. Should be updated and reviewed annually to make sure that they still exist and so on. If you're booking the depreciation, I'd like to see a continuity schedule showing how the depreciation booked reconciles to the net book value of the assets in the books. We have seen that, and sometimes we still make adjustments to it. Sometimes we don't. It really depends on the preference of the client and the bookkeeper. Intangible assets can be really important. If your client is developing intellectual property, start with planning, because this can be very important for SHRED. That's scientific research and experimental development. And if they don't know, and we've had this happen in the past, where they spent a bunch of money and none of it qualified for SHRED, and they were all angry at us. It's like, well, you didn't tell us this was happening. We had no way to help you prepare. So, there's something to keep in mind. This intellectual property, trademarks, patents, things like that, can be extremely important to valuing a startup in particular. Some other items that could be there would be goodwill, organizational costs, or licenses, copyrights, things like that. All right. I see Lynn raise her hand. So Lynn, what's up?
How would you normally see intangible assets reported?
Like on the balance sheet, they should be a separate line item. It depends on the reader of the financial statements and depends on their significance. So like if you have incorporation costs where the net book value is like $1,500 and you have other fixed assets of $1 million, it might all be grouped together. But if it's important for the reader of the financial statements to understand how much the company is invested in patents or trademarks, it should be listed separately. We've even had a situation where we had it listed separately. And then in the notes, we outlined very specifically each patent that they had there in the one trade.
Okay, where would that generally come from? Is that a year-end adjustment from the accountant, or how do you get to that intangible asset value?
How do you know what costs are going in there? That's a great question. 9 times out of 10, we've seen it from lawyers' bills. Usually it's legal fees. fees, and we'll get into that later, but that's why reviewing professional fees is very important. There could be consulting fees in there, and of course license and applications and stuff, but often those will flow through the
Yeah. No, I'm thinking of a particular client that they've developed specialized software that they subscribe out to clients.
Okay, so of course the software component should be capitalized in there as an asset, and then it should probably be there's a copywriting asset there, so there's something to develop. We had a very interesting case. I won't get into detail, but essentially a customer developing their own NFTs or non-fungible tokens, and that was a challenging one to put together. Essentially all we ended up capitalizing was a little bit of artist licensing fees that they paid, and then some salaries that went into developing. It's going to differ a lot, and it's going to vary client to client, situation to situation. All right, loans receivable. Remember the current and long-term portions. We often see them listed just as one item. Remember to record insurance or interest. Why do I keep calling it insurance? Interest properly, because what we do sometimes see is that all loan payments just go to the loan. So it understates the value of the loan, and of course understates revenue, and interest income is taxed differently. So it is important to record that interest income appropriately. And of course, we'll talk about this again, but watch for shareholders owing the corporation. This can create a situation of forcing it into income, creating double taxation on that money. Generally speaking, I mean, if a client is doing a lot of personal stuff in the business, they're essentially paying you to do some personal bookkeeping as well. And it's really like they're going to pay more because they're using it as a piggy bank. It's not advised. Accounts payable, very similar to AR, need to be reviewed for any cleanup, anything being written off, or anything that was paid out of the shareholder's pocket or an employee's pocket needs to be appropriately recorded. Every now and again, you'll see a negative balance in a specific vendor, and it is possible. Same with the AR side, but it needs to be validated. If you run your AR aging report or AP aging report and there's a negative balance, you need to confirm that that's correct. Quite often we find it's just a misstating of an invoice. Accrued liabilities, these are expenses that have, relate to the current period, but the bill hasn't been received yet. Most common are legal fees and accounting fees. Again, create a schedule and report that to your accountant. Loans payable, very similar to loans receivable. The one caveat is the CRA doesn't tend to care if the shareholder is owed money by the corporation, and they'll usually just go on, Steve. You have a question? You're on mute, Steve.
It helps if I do take the mute off. Sorry about that. Just curious, when you were speaking of negative balances, we've been running into a few when we're taking on new clients and we're seeing them, and it's because year-end adjustments are being done as journal entries rather than within the modules for both AR and AP. Drives me insane. Is there any way to, should we look for this? There's something, because it can be hidden very well in the AR and AP at the end of the year when you're doing the review. Any suggestions for that?
Well, the one thing I would say is depends on the type of engagement. I mean, the deepest we tend to go is the AP aging summary. So we're going to see if there's maybe an unmatched payment, like there's a negative payment ahead and the invoice is earlier. We're going to recommend matching that, things like that. We also, and I think this is one place where accountants can do a lot better, is communicate with the bookkeeper about the entries you want to make in those subledgers so that they're made correctly. You can make a journal entry, at least in QuickBooks Online, which is where we play. You can make a journal entry that hits accounts payable appropriately, and then you can match those things out and clear them out. It is possible, but I think this is a good spot for communication to be the go-to. All right, so we did loans payable, shareholder loans. Again, I'm preaching to the choir today. Everybody knows not to entangle business and personal. Your client's going to pay more for bookkeeping. They could create a bad tax situation. It's just lazy and silly frankly. Like, I mean, why create that extra work and then pay somebody to do it for what? What benefit did it give? Make sure that these are allocated to each shareholder appropriately, because we have seen situations in the past where one shareholder is owed a ton of money and the other shareholder owes the company a ton of money. So essentially one shareholder is living their lifestyle on the financing of the other shareholder. And that can create some really bad relationships and some really big problems. So that's something to keep an eye on. Also, this is a common area of fraud where shareholders are insisting that these are business expenses and they're trying to force or bully, for lack of a better term, bookkeepers into reporting them as business expenses. As accountants, we're never going to look at them. If you report them as a business expense, they're going to be reported as a business expense. So keep that in mind, you know, your professional standards and whether or not that should actually go in there. Another thing to keep in mind with shareholder loans, actually, you know what? I'm going to get to it when we get to that section. Taxes payable, these are the various R accounts. There are more than R accounts. There's a new LT account, for instance. And there could be a variety of different ones. They need to be reconciled on a regular basis. The balances need to make sense, and any penalties and interest need to be reported in a separate, non-deductible account. They're not allowed to deduct penalties and interest levied by CRA, parking tickets, speeding tickets, those kind of things. They're not deductible. It is an area that we see being ignored a lot by bookkeepers. Usually doing the first one is really tough. And then after that, it's super easy. And you can do it right in QuickBooks Online if you're using that tool. And it can make it very easy to do. If you are ever making an adjustment, particularly to sales tax, you have to make sure that you're doing the journal entry correctly, or it won't be picked up by the sales tax manager. I think a lot of accounting platforms operate similarly in that manner. So again, like if you're adjusting the GST, HST payable, make sure that's being done correctly. And if you're not sure, communicate with the bookkeeper, communicate with the accountant, figure it out. It is possible. Equity transactions are pretty rare. The most common we see is dividends. However, there's some things to keep in mind. We talked about the change in control earlier. And if there are multiple different types of stock, we prefer, and this is our preference, we prefer to see that broken down by the different classes and types of shares. So like Class A common, Class B common, Class C common, Class A preferred, Class B preferred. We'd like to see each of those accounts there if that's the situation you're encountering. Another area to keep an eye on is the loan agreements. If they're convertible into equity, what's going to trigger that possibility? You know, what's on paper matters more than a handshake. So keep that in mind, because a loan can convert to equity and cause a change in control. So that's something to keep an eye on, particularly with startups. All right, before I get too deep on the income statement, are there any questions at this time? I see Karen raising her hand, but she's on mute.
Yeah, my grasp of technology isn't working very well this morning. Intercompany accounts.
Yes, I didn't even mention
between related organizations.
Yeah, I didn't even mention them. Those should be reconciled.
Yeah.
If it is an investment in equity of the company, that should be listed separately out of an intercompany account. And that needs to be reported in notes. So Karen, that's a great gap that you identified in this presentation. I appreciate that. And that's feedback that I'll put in for next time.
Perfect. Thanks.
Thanks. Jennifer.
On that same note, that's something you should ask your client is, do you have any related accounts? I remember I had one years ago that CRA ended up phoning me and saying, oh, don't you know that there's this $10,000 a month loan agreement? You need to, or not loan agreement, rental agreement between this and some other obscure account that she owns. That, yeah, so.
Yeah. I would just frame that question a little bit differently. And I would ask, do you have shares in any other private corporations, because they're not going to understand the related and associated, and you
No, but-
probably aren't going to get the right answer.
Yeah, but definitely in the know your client part, find out if they're into any other ones. I
Yeah.
mean, it turned out that there was a huge GST issue between the two, even though problem was is they had this agreement, but they hadn't actually paid this rental, but the GST was still payable. But anyway, that's a whole nother
Mhm.
story.
Yeah,
But
it sounds
yeah,
like a
that's good
common,
point.
a little bit of knowledge can get you in a lot of trouble sometimes, eh?
Yeah, I'm glad I was done with them by the time that mess came up. But anyway.
Lynn.
Hi.
Hi.
So the intercompany accounts. I had a situation years back where I didn't know it up front, but it turned out that there was intercompany connection. And the one company was floating a lot of money into the second company, and I walked away from the experience, literally walked away from the job. But my experience there told me that if there's any kind of intercompany work, I want to be the one doing both of them so that I know that there's no
No funny business.
funding issues or fraud.
Yeah, well, that's a good point, right? Like, I mean, there could be fraud there. We don't know if we don't have the whole picture. And you know, there's a story of somebody who had an accountant, and he found out about the small business deduction, and that it was being split amongst his 5 corporations. So he fired the accountant and went to 5 different accountants and didn't tell them about the related and associated. Well, CRA came back a while later, and like a few years later, he owed $2 million.
Yeah.
So, you know, it can really result in some bad situations.
Yeah, I
All
had
right.
a very funny feeling about that one.
Trust your gut. It's usually right.
I did.
Jonathan, there's just one question in the chat, so I'll just read
Sure.
that out. Shareholder loans accounts should be classified as current liabilities or non-current. GIFI mapping has both options, and I felt confused. Can you help clarify?
So typically what we do is we have them classified as current because they should be repaid within the year. However, we know that doesn't always happen. When we do have a longer term shareholder loan, so for instance, you know, so-and-so has money and they're a shareholder and they loan the corporation it under a shareholder agreement or under a shareholder loan agreement, and it's payable over multiple years, then we have to split the current and the long-term portion. Usually that's accompanied by an interest rate too. All right. I'm going to zip through this last part because this is really important. So passive income, this is things like royalties, rental income, licensing, things along those lines. One thing we had a great conversation the other day about was YouTube and TikTok income, because that is passive income. This is very useful for establishing the value of companies, and a good passive income stream can make a company quite valuable. Active business income that would come from product sales or services. You know, keep an eye on your locations of where your customers are being sold to. Keep an eye on the sales tax. The accountant at the end of the year, we're going to be doing like cleanup if there's a situation. The client is going to end up paying significantly more because they didn't register. There's penalties and interest. There's going to be additional fees to the accountant to clean that up. So the bookkeeper is the one who can start that first. And again, with the product sales, you know, keep an eye on that inventory. Make sure that it's actually being sold and not pocketed or falling off a truck. Services, the one key thing that's different is how many customers does the company have? If it's a service-based company that's working for a single customer, which you often see for IT professionals and consultants, it could be considered a personal service corporation, and they could be in a different tax situation. So that's very important to understand and to bring to the accountant's attention. Also, there's a good opportunity to upsell time tracking here, because even though it might be a one-person show, understanding how the time is being used can be very valuable to determining and improving profitability, in particular with margins and the types of projects you take and things like that. So legal and accounting invoices, professional fees, we should look for all of these. We should look at all of these. Some of these need to be capitalized. We've seen many times where people try and push their personal things or things that belong to another corporation, like a holding company or things like that. So you get a legal bill, it might be an intercompany transaction, could be a shareholder loan, or it could need to be capitalized, or it might be a legal expense. So those are things to keep an eye on. From the accounting standpoint, if you see things like that, it's probably going to be more about a restructuring or something like that. And then this is where you'll see the stuff with regards to trademarks and patents. So Carol, what's up?
Just a quick question. So this has come up for me in the past with clients I no longer have, but where they've had two companies doing similar, different things for the company, but like one's construction and one's say painting, whatever. But say they'll buy all the supplies from one supplier, like say Poco Building Supplies. So it's under company A, but some of the invoices are for company A and some of the invoices are for company B, but because the credit on the vendor account is under company A, but they still want the bills entered into company B, but it's technically the wrong company name. For me, my brain has a problem processing stuff like that. Is there anything on that from a legal standpoint?
All right, not being a lawyer, I'm just going to avoid that question completely. But what I am going to say is,
or from
on
an accounting
review,
standpoint, right?
if CRA sees a bill that the company claimed it's not in the company's name, they're going to deny that bill, that expense, and they're probably going to dig deeper and look for more problems. So it's risky behavior.
Yeah, no, and I did find it to be a very huge problem. One of the reasons why I disengaged with the client, one, it was just really messy. Oh no, that should be in this company. Oh no, that should be in. How am I supposed to know?
Yeah,
I go by the company name, who it's billed to, right?
Those kind of buying, that kind of buying power, I have seen. There's actually companies out there who all they do is buying power. That's all they do. And the money or the bill can come into one company, and then essentially it can be the inventory or whatever, it can be transferred to the other through intercompany and that kind of thing. And then there is still liability, but now it's an intercompany liability instead of accounts payable.
Yeah.
Lynn?
You raise an interesting with the legal accounting professional. Normally I see it all in one GL account.
Yes.
Would there be a benefit to having those as sub-accounts?
100%.
Okay.
So we actually, when we do it, we have accounting fees, legal fees, consulting, and coaching. And that's because we work with a lot of people who work with coaches, and professional fees get reviewed often. On the Giphy file, like when we're taking it from the books to tax, having it split out allows us to allocate it more specifically and reduces the risk of the client being reviewed.
Yeah, and that was piggybacking on what you said earlier about the intangible assets and the legal fees, and I'm thinking, okay.
Yeah. So those kind of intangible assets, they might need to be capitalized.
It would be easier to pick them out too.
Yeah, absolutely. Absolutely.
Yeah.
Steve?
We do that absolutely, because when we're reviewing financials with the client, I don't like those big legal bills to make it look like the accounting and legal side that reflects poorly on us. And we've even gone so far as to break the bookkeeping out separately too. So we have bookkeeping, accounting, and then legal.
Yeah.
Find it's just easier for the presentation. So I'm so glad you guys brought that up.
That's a good one. I mean, on the compiled or audited financials might end up being one line, but on the tax return, it should be multiple.
As you said, well, even so in the Giphy, so that's interesting then. So when you push it through through Giphy to the T2, so you are still breaking it up on there. You're not just we have a habit of at that point we just push them all in together. But you're saying keep them separate?
I prefer to.
Interesting.
It
Okay,
just makes it more clear. I mean, there isn't I haven't encountered any kind of regulation or legal requirement that requires you to split them out or condense them. I've seen 4-line income statements on tax returns, and that's not really helpful. And I do know this information is used not just for selecting audit and review, but also by Industry Canada to help understand, what's going on in business.
Yep.
Sorry, last thing I'm going to say about this is personal tax returns. A lot of particularly owner-managed companies will try and justify that their personal tax return is a business expense. It is a personal expense. It can be deducted on line 221 of their personal tax return, or 22100. Meals and entertainment.
Sorry, can it still be deducted on the, okay, so personal side, personal tax preparation is not deductible, is it? Unless there's a sole proprietorship or a partnership or rental property.
If there's any kind of investment income.
Oh, okay, thank you.
Line 22100.
Yep.
Yeah. Big one there that's missing, and look this up later, the Smith maneuver with a Y. If you don't know about it, that's oh, you know that one? Okay. So that can result in a lot of write-offs on that line item when you borrow money to invest. So, all right, I'm going to go quickly through this. This is the thing that causes the most friction with our clients. Sending us meals and entertainment or gift receipts with no information, and we're always asking them about it. And we're always explaining, like, listen, this is for your protection. If you don't have this, this is going to be forced into income. The CRA is going to deny the expense for the company, so the company has to pay tax on it, and then you have to pay tax on it. So keep that in mind. Always we're encouraging this kind of appropriate documentation. Don't go out and buy $1,000 worth of LCBO gift cards on December 18th and claim they're all gifts when you're just drinking on the corporation's dime for the rest of the year. Vehicle expense is another area where we see a lot of pushback. Keep an eye on how you're claiming the GST, HST in those instances. Make sure the vehicle's owned by the corporation if it's going to show up on the balance sheet. That's a very common problem that we see. And keep that logbook. I don't care what justification you use. A tier 1 reviewer is going to deny all vehicle expenses the minute you cannot provide a logbook. 100% of the time, the tier 1 will deny everything, and then things just become more complicated and more expensive for you. Carol.
I just wanted to grab a quick question on that. So if you have, like, I have a client who's a welder and it is a welding vehicle, it's 100% business because it's not used for anything else, and it's stored at, like, they have a location where all the vehicles sit. So he drives from home to the storage place, picks up the vehicle, works for the day, comes back there, drops it off, drives home. Are you saying that he still needs to have a logbook even though it's 100% for business?
Yeah, because CRA could say, oh, well, there should be a standby charge. It should be pushed back.
But
you
there's
don't
no
know what
standby
you're going
charge.
to, you don't know what the CRA agent's going to do. Right?
Okay, no, good to know. I just, when it's been 100% for business, I've never insisted on them keeping a logbook.
Yeah, CRA can be kind of sticky about things in this realm.
Nope, good to know.
Better to CYA. Lynn.
Well, just to piggyback on Carol's thing, because I have a client that has more than one vehicle that's used strictly for business. It's because it's outfitted with all the equipment that he needs to do his business. He doesn't drive around willy-nilly for anything. He has his own personal vehicle for that. It's tracked carefully in so much as the jobs, we could go back to the, and create it from the invoices as to what the jobs, because he travels 100 kilometers that way and maybe 150 kilometers the other way.
Mm-hmm.
So he puts in a lot of mileage. So, but we've never kept a logbook. And if I introduce that to him now, and he's been doing this since 1999, he'd have a fit.
Well, I don't know what to tell you about the customer relationship there, but I have always seen CRA give a big problem if there's no logbook every single time. Now, the logbook is not a legal requirement. It's an administrative requirement from CRA. And I have seen tax lawyers successfully claim that, this is reasonable because that's the letter of the law in the Income Tax Act is reasonability. So I apologize, everyone, but we're definitely going to go over time. There isn't a whole lot left, but I'm going to keep going through if I can. Lynn, can we pick it up at the end?
Yeah, we can.
Okay. All right. Thanks. So non-deductible expenses, keep in mind, legal settlements, penalties, interest, fines, parking tickets, all those things are non-deductible. They need to be separated into another account. One thing that one of our bookkeepers introduced to our team that's really helped is separating the penalties and interest by what they are. So we know if it's WSIB or if it's RP account or if it's RT account, and it makes the reconciling much easier to understand that. So that was a great idea from one of our bookkeepers. All right, last poll question so people can get the CPD. What are considered financial information? AR aging summary report, T2 tax return, compiled financial statements, A and B, or none of the above?
The poll disappeared.
I think Sandra's working on it.
Oh. To answer it. Oh, there we go.
Hey, I can answer this time.
If I relaunch it, it allows everybody to vote now. So you guys can all vote.
I see Karen's lips moving. I don't know. She's holding a finger in the air like.
So sorry, I'm talking to Alan, who's literally on the other side of my screen.
Oh, okay. Sorry.
So we've got 13 out of 15. I didn't vote. Jonathan, did you vote?
I did.
Okay. I'll give it another couple seconds. Okay, perfect. And I will end and share the results.
Interesting. So the correct answer is A and B. Yeah. So the tax return and AR summary are part of the financial information. The compiled financial statements are financial statements. Okay. All right. So we're almost there. In summary, understand what your client needs and help them get the help that they need. Make sure the accountants you're working with are qualified and above. Make sure that you provide the general information. Really push the client to update their corporate record book annually and provide that. And make sure you provide the information the accountant needs for those balance sheet accounts and the key income statement accounts. So one of my favorite quotes: by failing to prepare, you prepare to fail. It's kind of nicely bookended by the Muhammad Ali. Everybody has a plan until they get punched in the face. But anyway. All right, I do see there's a question in the chat. So I think this comes from the loan section. So if there's a sole proprietor regarding the name on the loan. So the key thing to know in this situation is that the loan is 100% used for business purposes. If there's any blending whatsoever, all the interest is no longer deductible. So if a sole proprietor is using a credit card and that credit card is incurring interest and it's blended business and personal, that interest is not deductible. If they're using a dedicated credit card for the business and that incurs interest, that interest can be deductible. But you have to remember the onus of proof is always on the taxpayer in this system, in our system. So I felt like that was very rushed and we really went through it really quickly. There's a lot of meat there. Are there any questions or any stories? Lynn, did you want to go back over that, the client, things like that?
No, the only thing I was going to say, Jonathan, we did have a compliance audit a few years ago. They never said anything once we took the auditor out and showed him the inside of the vehicles and how they were set up. He's not taking them out. They're work vans. He's not taking them out to do personal errands.
Yeah. We had a situation where somebody got a review, like one of our clients got a review, and they literally have, it's essentially a moving truck.
Mm-hmm.
And at that time, they had no brick and mortar office. So it sat in the shareholder's driveway. It was taken up every morning by somebody else, by an employee whose whole job was procurement and delivery. So he'd go around, pick up supplies, drop them to job sites, and then bring the truck back. And they still gave a very hard time about that. In the end, they denied some vehicle expenses from other vehicles, and they allowed the vehicle expenses with relation to that truck. But they were trying to do like a personal standby charge to the shareholder, and like, you don't have a mileage logbook, so we could deny everything. And it became a bit of a headache and a bit of a scare. But the whole catch more flies with honey than vinegar, we were able to talk them into, okay, you're going to deny all the expenses related to the owner's vehicle that he's charging back the mileage to the corporation, and you're not going to deny the expenses related to the moving truck. But that's anecdotal, and like that really depends on the person who's reviewing the file. Some people would be very aggressive and just say no logbook, no deduction.
Yeah. Well, and it depends on the auditor and what kind of an attitude they've got. I know that there was another business owner that he wasn't doing the same work, but it kind of a similar model, let's say. And they were audited a few years before us, and the auditor disallowed all of his vehicle fuel because he said, in quote, that vehicle should get X kilometers per liter, gallon, or whatever, and it was using more. But he didn't take into consideration the traveling in the lower mainland Vancouver area where you're sitting in traffic for an hour, burning fuel.
Yeah.
But disallowed the whole thing.
Really, the conversation you have to have with the client is, do you want to pay for a bookkeeping done right, or do you want to pay for a lawyer?
Yeah.
Right. And most people right away would rather do it right. But yeah, there has been some success, and there's been some interesting case law about vehicle deductions, and in particularly high value vehicles. And I think we're going to see a lot more, particularly when it comes to influencers. And they love to drive around in the Tesla and show off stuff and try and write everything they can off. And there are some interesting strategies with how to make sure that you're getting the expenses. But generally speaking, the vehicles the CRA gets really sticky about.
But isn't there a limit on high value vehicles for business?
There is.
Isn't it? I thought it was 30,000.
It depends on, an EV vehicle is higher.
Oh,
but we had to have this conversation with somebody. And then there's the 6-ton rule, which is not a strict rule. So like if you're buying like an 18-wheeler, of course, that's all amortizable, right? It's a different CCA class. But we had to have a conversation with somebody who's like, oh, I need to use up profit so I don't pay as much tax. I want to buy a $400,000 car. It's like, you don't want to buy a $400,000 car. That's stupid. It's really stupid. So we talked them out of that. And essentially the strategy we're using for this particular influencer is when they're doing a shoot and they want a high value vehicle in the shoot, they're going to rent it. They're going to rent it. It's going to be directly attributable to that content. They do not own the vehicle. It's a 1 or 2 day rental. And that's it. So hasn't been tested, but we'll see what happens with that. Oh, Steve just came back.
Steve's always here for you, Jonathan. Always.
Oh, thanks, Steve. So with regards to the package, one thing that I really didn't get into detail with was to make it a package. So for instance, from Sandra, we get a file where a lot of the stuff is already done in QBO workpaper. She downloads and gives us the whole zip, which has the attachments, her comments, her notes, and things like that. From another very reputable firm, we usually get like a SharePoint, a file sharing thing, or a OneDrive file sharing thing. And then another firm, they provide us a single PDF and then send us the share files, and we can put it all into our Google Drive. So that's some different ways. But that single page PDF, it's like, that communication, like Lynn said, like, client wanted to do this. I really push back. This is what happened. You might want to talk to the client about it. Those are good things to identify. We just recently started working with a new bookkeeper who he identified all of those things on the work paper. The way we work is We prepare the word paper for questions. We go to the bookkeeper, then we absorb those answers, and then we go to the client for whatever remains. And yeah, he just like the communication was fantastic there. It's like, you need to talk to him about this because we've had this discussion a few years in a row and this is still happening and things like that. All right. Any more questions? Well, I just want to say thank you very, very much for the high level of engagement today. This has been a stimulating conversation. I hope you have found it valuable. In my opinion, I think this is one of the more valuable presentations that we do. Just a reminder, there is no webinar scheduled for December, but depending on the timing of our new arrival, like I'm talking about me personally, we may do one in January we're trying to work out the details. So I'll let Tawny put that one out there if we are going to do it, but I'm hoping that one's going to come to fruition. So no webinar in December. So have a wonderful holiday. Have a lot of holiday cheer. And yeah, thanks everybody.
Thank you.
Always a
Thank you
pleasure.
very much.
Always a pleasure.
Have a great holiday too.
Thanks very much.
All right, take care everyone.